Hello everyone and welcome to today's Mondat webinar in association with G Alliance, who will be discussing recent developments in the corporate tax landscape in Nigeria regarding non-resident companies. My name is Dan Sampaio and I'm joined by a brilliant panel to take us through today's discussion. Moderating today's session is Fidelis Adewole, Managing Partner of G Alliance. Fidelis has over 17 years experience as a legal practitioner and has advised local and multinational entities on major transactions. He is a fellow of both the Chartered Institute of Taxation of Nigeria and the Chartered Institute of Arbitrators in the UK. Fidelis is also an associate of Chartered Institute of Stockbrokers, and he is a notary public and a member of the Nigerian Bar Association and the International Bar Association. But before I hand over to Fidelis to introduce you to Emmanuel and Stephen, a housekeeping item. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page. The panel will endeavour to answer as many questions as possible during our Q&A session. Please do reach out after the webinar for any additional information that you may require. It's now my pleasure to hand you over to Fidelis to begin. Thank you.
Thank you, Dan, and good afternoon, everyone. Once again, my name is Fidelis Adewole. I'm the managing partner of G Alliance & Co. Let me just introduce my firm to you briefly. I work with G Alliance. It's a business law firm with offices in Lagos and Abuja. We have over 60 lawyers. We work in over 20 practice areas, and all our clients work in all sectors of the Nigerian economy. We provide services ranging from M&A, dispute advisory, including tax advisory. So in discussing today's topic, recent development in corporate tax landscape in Nigeria in relation to non-resident companies, I have Mr. Emmanuel Eze and Mr. Stephen Chima Arubike. Mr. Emmanuel Eze worked as a senior manager, legal services and tax policy with the Federal Inland Revenue Service, where he was until his recent sabbatical, the head of International Tax Policy Development Unit, and part of Nigerian contingent to the ongoing OECD Inclusive Framework BOCAD negotiation on the taxation of the digital economy. Mr. Eze is well acknowledged nationally and internationally as a leading expert in the taxation of the digital economy. His work with the International Tax Policy Development Unit placed him at the forefront of the conception and design of the Nigerian policy in the taxation of the digital ecosystem. Mr. Eze is trained as a lawyer and has LLM in international taxation from the University of Melbourne, Australia. My second speaker for today is Mr. Stephen Chima Arubike. Stephen Chima Arubike is a partner in the firm of G Alliance & Co. and he has the tax practice of the firm. As I said initially, G Alliance is the leading full-service business law firm in Nigeria. Mr. Stephen is a fellow of Nigerian Chartered Institute of Taxation and a well-recognized and sought-after tax expert. He has advised the public and private sector, local and multinational clients on the tax dimension to numerous seminar and complex transactions. He also represents leading global clients in significant tax litigation before the tax tribunal and superior courts in Nigeria. In recognition of his expertise and excellent client-oriented service, Mr. Stephen was recently recognized as a highly regarded individual by the ITR World Tax Rankings in its 2023 edition of World Tax Guide. He was also recently recognized as a recommended lawyer by the Legal 500 in its 2023 rankings. The tax team of G Alliance is led by Mr. Arubike, has also been recognized as the foremost tax team of any law firm in Africa, with the conferment of the African Tax Team of the Year at the 2021 Africa Legal Awards. So they will be doing justice to today's topic. But before delving into today's topic, it's pertinent for me to mention that due to time constraints, we might not be able to examine all of the taxes that may be applicable to the topic at hand. Our focus for this webinar will be mainly company income tax and VAT, value added tax. Taxes such as capital gain tax, stamp duty, petroleum profit tax, education tax, and profit trust fund levy will not be our major focus in the discourse of today. Now, there's no gainsaying that Nigeria has one of the lowest tax to gross domestic product ratios in the world. Our tax revenue is far below what we need to execute our budgetary requirements for our economic and infrastructural developments. Considering the dwindling oil revenue and efforts by the Nigerian government, an effort to widen the tax nets and to raise the tax to GDP ratio. Mr. Steve Arubike, may I ask, can you provide us with an overview of the taxation of non-resident companies in Nigeria, highlighting some of the factors that will impact the tax liability of non-resident companies in Nigeria? Mr. Stephen, over to you, please.
Sorry, Stephen, you are on mute at the moment.
Mr. Adewale, thank you very much. Nigeria, like other countries around the world, imposes corporate income tax on profit of companies. The country operates a federal system of government where the taxing powers are shared among the three tiers of government. By the constitution, the federal government imposes and administers corporate income tax. The principal statute is the Companies Income Tax Act. Of course, there are other taxes that impact on the income of companies like tertiary education tax, national information technology tax, and police trust fund tax. Further, there are also sector-specific taxes for upstream oil and gas companies and lottery operators. Before year 2020, the country imposes a corporate income tax on the net profit of companies at a flat rate of 30. So after the financial 2019, the rate changed to the extent that companies earning turnover below 25 million pay at a zero rate, while those earning annual turnover between 25 to 99 million pay corporate income tax at a rate of 20. Others pay at a 30% rate. So broadly speaking, tax statutes in Nigeria reserve the country's right to impose income tax on both the income of the resident and the non-resident companies alike. Specifically, under the Company Income Tax Act, Nigeria can tax the profit of companies accrued in, derived from, brought into, or received in Nigeria. In practice, however, Nigeria imposes income tax on the worldwide income of its resident company, irrespective of the source. In other words, the country taxes the income of Nigerian companies earned domestically and those earned abroad, and the same rate applies to both domestically earned income and those earned outside Nigeria. Nigeria imposes corporate income tax on non-resident companies only on limited and specified occasion. Although the tax treatment of income of non-resident company and the resident company is basically the same, there are some specific factors that will impact on the tax liabilities of non-resident company, including the allocation of taxing rights in ways that differ from Nigerian company. We shall look at some of these factors briefly. The first thing to consider is in taxing a non-resident company is to determine whether there is actually taxable profit earned in Nigeria. Unlike Nigerian company, where there is no taxable income earned by non-resident company from their Nigerian operation, they will not be taxed at all. The second factor to consider is the double tax treaty between Nigeria, whether there is a double tax treaty between Nigeria and the country where the non-resident company is incorporated. Where there is such treaty, the treaty alone determines the allocation of tax between Nigeria and the other country. If there is no allocation of profit in the double tax treaty, the non-resident company will not be taxed. And if there is a conflict between the treaty provisions and the local statute, the treaty provision supersedes that that of the local statute. The next thing to consider in taxing non-resident company is the nature of the income. Now, we look at if the non-resident company only earn passive investment income, the rate is usually, the income is usually taxed at the rate of 10%. However, if the non-resident company earn income through business operation, the normal rate stipulated in the statute will apply. Nigeria also consider whether the income of the non-resident company is earned through digital operation or non-digital operation in determining whether to tax the non-resident company. Where income of the non-resident company is earned through digital operation, or where that is to say, where the non-resident company is providing digital product and services, the new regime stipulates that we have to consider whether the non-resident company has significant economic presence in Nigeria before that non-resident company will be taxed in Nigeria. The last factor to consider in taxing non-resident company is whether the income or the profit of the non-resident company is accessible or not. Under Section 30 of the Companies Income Tax Act, the Federal Inland Revenue has the right to assess companies based on the annual turnover. Now, this power, the power under Section 30 is not usually evoked in respect of Nigerian companies. However, the non-resident companies are usually taxed based on the turnover. So what happens in that instance, where the profit cannot easily be assessed, the tax authority take a percentage of the turnover of the non-resident company and impose tax on the non-resident companies accordingly. So these are some of the factors that the Federal Inland Revenue or the tax authority consider to determine how and the rate to be applied in taxing non-resident companies in Nigeria generally. Thank you, Mr. Adewale.
Thank you, Mr. Arubike. We have learned from Mr. Arubike that in determining whether a non-resident company will be liable to pay tax in Nigeria, there are a lot of factors to be considered. One of them is whether there is taxable profit in Nigeria. So if there's no taxable profit in Nigeria, that means it won't be there won't be tax payable. The double tax agreement between Nigeria and the non-resident company where the company is incorporated will be another factor. Again, we have also learned that the nature of the income will also determine the amount of tax to be paid by the NRC, whether it's from passive income or it's from business operation. As well, we also learned from Mr. Steve that a lot will also depend on the kind of services or products being rendered by the NRC. Is in relation to digital services and products, then the question is whether there is significant economic presence in Nigeria to make the NRC liable to pay tax in Nigeria. Thank you, Mr. Arubike. Now, let me go to Mr. Eze. From your experience as an international tax practitioner, what is the prevailing international practice among nations as to the taxation of non-resident companies, particularly those operating in the digital space? As a corollary to that question, what are the circumstances in your view that will make an NRC, non-resident companies, subject to such tax in Nigeria? Over to you, Mr. Eze. Thank you.
Thank you, fellow Nigerians and listeners. Thank you, Mr. Fidelis, for the question. As a matter of fact, there is no one-size-fits-all rules for taxation of non-resident companies across the world. And from our experience, we will say that when you tie it down specifically to taxation of digital enterprises, the practice is evolving. And we will highlight some of what we consider practices across the world. To start with, who is a non-resident company? This simple question is defined variously by different countries. For Nigeria, a non-resident company is a company not incorporated in Nigeria. For UK or some other countries across Europe, a non-resident company may be a company that is not effectively managed from their jurisdiction. So in this sense, you could still to see the divergence that while for Nigeria, incorporation alone is enough to determine whether you're resident or non-resident. For other countries, where you are managed from effectively may be the determinant of where you're resident. So you may have a company that is incorporated in the UK, and they are not they are not resident for the purposes of taxes in the UK. So give and take. This shows you the divergence on approaches to taxing companies, non-resident companies across the world. Another aspect is how do you actually apply the tax? When do you say that nexus, you have a taxing nexus to apply your taxes? So traditionally, multinational enterprises, that is enterprises that have business operation in more than one country, they would only be liable to tax when they had physical presence. And that physical presence could be warehouses, it could be factories, it could be business establishment, among others. And when you look at the treaties, the tax treaties, you look at the Article 5 of model tax treaties, you will see what is called permanent establishment. The permanent establishment, for the most part, is built on physical presence. Do you have taxable physical presence? Some of them are quantified by time. If you have physical presence, have you had it? If you have treaties for a 6 month or 12 months, as the case may be, depending on the models. So this is standard nexus for taxing multinationals as at the moment. But the problem started when the digital enterprises started to emerge. Because under the old regime, the brick and mortar businesses, when they have physical presence, you can see them pass through your borders, you can see the establishment, and you can apply your tax. But following the advance in technology and of course breakthroughs in global logistics, entities are now able to sit down in one country and do business in multiple jurisdictions without the need to have physical presence, what you call ability to scale without max. So, and this is where the digital enterprise is coming. If you look at the top 10 global entities in the world, about 5 or 6 of them will be digital enterprises. And these enterprises, they make a lot of profit from market jurisdictions. And of course, there's no rule to tax them because the rules was based on physical presence. So over time, countries started mapping out approaches to taxing these entities. And part of the approaches have been digital service taxes. You would have heard around the world about digital service taxes. Those taxes are designed, one, based on market elements like what revenue is the M&E deriving from a particular jurisdiction, what customer-related element is there to ensure that they derive those revenues. And they are also designed in a manner that they target only non-residents. Again, they are not part of the corporate income tax of most countries. Examples of countries across the world that have adopted digital service taxes include Kenya. Of course, at a point, Europe has a directive on digital service taxes, and France and others were all partakers in this. But again, there's a challenge when it comes to impediment to trade. So you had some countries like United States raising issues that this may constitute impediment to trade. And based on that, they started pushing to say you could not do this. So some of them have dropped it in anticipation of a multilateral approach, which is designed to produce a more holistic and consistent way of taxing digital enterprises. Then you also have another approach coming from countries like India. They are part of the equalization levy. And then back in Nigeria, we don't have digital service taxes in Nigeria, but they have significant economic presence rules, which have been mentioned by Stephen. That rule was introduced in 2019 by the Finance Act 2019. And the essence of the rule is to say that if you're a digital enterprises and you exploit the local domestic market of Nigeria, whether or not you have physical presence, if you derive income that is up to 25 million naira, which coincidentally is also local domestic de minimis exemption, if you are able to derive 25 million naira, you are subject to tax in Nigeria. The rule is built on what Stephen have outlined earlier on to say that when you derive income from Nigeria, you are liable to tax. So if you go under section 13 sub 2 of the Company Income Tax Act, you will now begin to see instances where your income will be deemed as a non-resident to have arisen from Nigeria. One of them is when you have done contract in Nigeria. One of them when you are operating in digital space, and of course you are deemed to have significant economic presence based on a revenue threshold. Number 3 is when you furnish technical services to entities or persons based in Nigeria, among others. So this is Nigerian approach. Is the approach perfect? Of course not. But the good thing is it operates within the framework of our domestic income tax. That is to say, if you are an MNE doing businesses from countries with whom Nigeria have tax treaties with, the significant economic presence rule do not apply to you. Because again, like Stephen pointed out, Section 45 of the Company Income Tax Act states that where there's a treaty arrangement, the treaty provision will supersede the domestic tax law provision. In essence, it is saying that if you have tax treaties with Nigeria, what will be applicable will be Article 5 of that tax treaty, which deals with permanent establishment, as against the significant economic presence rule. All right. The question now becomes, for those that are under significant economic presence rule, how do you attribute profit? Then you go back again to Section 30. You are expected to file in good faith and make payment of necessary taxes. But when you have filed inaccurate report or file a report that the tax authority, when assessing it, will see as not to have produced the expected profit, they will resort back to the anti-abuse rule in Section 30 to say, we do not believe in this your filing. We are going to file you on fair and reasonable percentage of your turnover. In essence, in practice, what they do is to deem 20% of your turnover as profit and apply 30% tax on it, or 20% as the case may be, depending on the size of the entity, and then charge you to tax based on that. So in summary, both the corollary to your question and the substance of the question itself, this could be my response. Thank you very much. Thank you.
Thank you, Mr. Isaac. We have learned from heard from Mr. Isaac that prevailing international practice is very among nations. Starting from the outset, that the definition of a non-resident company even varies. Like in Nigeria, is a place of incorporation, and as we heard from Mr. Isaac, from the UK, it could be where the management of the company is being administered from. That would be the residence of the company. And as to different practices, we heard him talking about digital service tax approach applicable in Kenya and France. Nigeria, we have adopted the approach of significant economic presence, and it varies. It all depends on whether you have a DTA, a double treaty arrangement with Nigeria. If that is the case, and that will override whatever we have provided under our local law here in relation to the significant economic presence. Mr. Steve, let me come to you. In terms of approach now, how has Nigerian approach to the taxation of non-resident companies changed in the last 5 years in relation to what we've been discussing? Thank you.
Thank you, Mr. Adewale, and thank you, our distinguished audience. Indeed, the approach to taxation of non-resident company has undergone significant changes over the past 5 years. I mean, if you're looking at the tax space for this for the past 5 years, you will understand that Nigeria have been passing or enacting a finance act towards the end of the year. Additionally, the federal government has also entered into several multilateral conventions and agreements, and all these impact on the non-resident company. Based on these developments, we can identify 3 broad ways in which the taxation of non-resident company has evolved. The first one is introduction of new taxes on digital product, which Emmanuel has highlighted. The taxes is both on the normal income tax and taxes on digital product through withholding taxes. Now, the second significant change is that Nigeria, there have been a greater disclosure and reporting obligation which have been mandated both on non-resident company and their foreign parents or affiliates. In fact, this move is to promote tax transparency, prevent shifting of income to other jurisdictions. But let's see a few examples of such disclosure and reporting obligation. Nigeria signed up to 2 multilateral instruments in 2017 for exchange of information on tax and financial matters. Immediately after signing to these instruments, we also have the 2018 income transfer pricing regulation and 2018 income tax country by country regulation. These 2 regulations not only impose high level of reporting obligation, it also prescribes stiff penalty for violators. Fourthly, there have also been requirements for free zone enterprises operating in Nigeria to file their tax returns with FRS. As you know, free zone enterprises are not subject to local taxes unless their products are being provided to Nigeria. However, there have also been abuse of the free zone tax exemption. So what FRS have done is to mandate them to file their tax return. Yes, you are not liable to pay tax, but let us see, open your book and let us see how your income, how you are earning income in Nigeria, and whether the income is actually exempt from taxes. There's also a requirement, a current requirement for all non-residents in Nigeria who are earning income other than by way of withholding tax to file their tax returns with the tax authority, including, among other, full audited financial statement, the financial statement of their Nigerian operation, tax computation and schedules on the profit attributed to Nigerian operation. And of course, once this is implemented, it even reduce the reliance on turnover tax on the non-resident companies. The third thing that we have also noticed is on removal or sometimes reduction of tax reliefs and incentive granted to mostly non-resident company or tax relief that are being enjoyed by non-resident company. So what government have taken steps to remove this incentive previously enjoyed by some of these by some non-resident companies that qualify for some of the exemptions. For instance, before now, a non-resident company that invested in a long-term debt instrument in a Nigerian company is entitled to up to 100% tax exemption if the tenure of such instrument is up to 7 years. So what Nigeria have done is to reduce it to 70% exemption. So there's no more complete exemption from on income earned by such a company through passive investment in a debt instrument issued by Nigerian companies. There's also a termination of the withholding tax incentive on corporate bonds and notes issued by Nigerian company. This exemption lasted till January 2022, and there was expectation among the stakeholders that there would be an extension, but Nigeria did not extend the exemption on the corporate bonds and notes issued by Nigerian companies. There's also a removal of the minimum tax exemption on imported equity granted to non-resident companies that invested granted to Nigerian company where non-resident company have invested up to 25% imported equity. As you know, minimum tax is a device that the government, the tax authority is using to ensure that there's ensured that companies pay their tax, or companies are not abusing their tax. They are not abusing their tax exemption. So non-resident companies that invested in Nigerian company, the Nigerian company are exempted from alternative minimum tax, but these have been removed. There's also the exemption also granted to withholding tax exemption also granted to upstream oil and gas company have also been removed. The section 60 of the petroleum profit tax that grants exemption on income and dividend paid out of the after-tax profit of the petroleum company have been removed. Before now, oil and gas company, and this sector is dominated by mostly multinational, are not paying withholding tax on the income distributed by such company. So what has happened is that the Financial 2019 deleted section 60, now making such companies withholding tax to be liable to tax in Nigeria. So in conclusion, the government evolving approach to the taxation of non-resident companies reflects its efforts to ensure fair taxation, address global tax challenges relating to digital economies, and also to promote greater tax transparency.
Thank you, Mr. Arubike. Good to know from you that the apples are changing over the last 5 years, and you have classified in three broad categories. For the purpose of summary, I would say you have something called introduction of taxes on digital services and products, which mainly on how to tax the income of the provider of these services, non-resident companies. And again, you talked about the greater disclosure and reporting obligations on NRC so as to promote transparency. You also talked about the removal and in certain cases reduction of tax reliefs previously enjoyed by the non-resident companies. Thank you so much. Moving on, I'll be going to Mr. Eze, and I'll be taking you now to have a global perspective of what we are discussing. In your view, what is the Nigerian current position on the two-pillar solution proposed by the OECD? Over to you, Mr. Emmanuel.
Thank you, Mr. Fidelis. Thank you, listeners. For us to begin to unpack Nigerian position with respect to two-pillar solution, I have to first say one, I don't speak for Nigerian government, not anymore. So, but of course, we can decipher the position based on public comments and of course, populations. What's the two-pillar solution? The two-pillar solution, as I highlighted earlier on, represents a global approach to have a consistent rule that apply, one, to taxation of digital services, and secondly, to ensure that MNEs are subject to minimum global tax rate, irrespective of where the operations are at any given year. So that's the pillar one. Pillar two. The pillar one sought to establish a taxing nexus without a physical presence. I recall when I pointed out the problem. That's the whole essence of pillar one, amount A. Then the pillar one, amount B, is about simplification of application of transfer pricing principle, the arm's length principle on baseline marketing and distribution activities of MNEs, especially for low capacity jurisdictions like some countries in Africa and the developing world. Now, what is Nigerian position with respect to pillar one, amount A? If you go back to 2021, when the OECD inclusive framework came up with an outcome statement mandating the technical arm of the organization to continue to work on these two pillars, Nigeria did not endorse that outcome. And when confronted on rationale behind them not endorsing, the Nigerian government at the highest level, which include both the finance minister and other high-level officials, stated that one, they didn't endorse the outcome because the scope was narrow. So the problem we have is that there are many digital enterprises that are doing business in our jurisdiction as developing countries or market economies, and we can't tax them because the original rules say they have to have physical presence for us to tax them. And the solution developed under pillar one, amount A, is to say, yes, we acknowledge that there is a problem, and we are developing a rule. But this rule will not apply to all digital enterprises. It will only apply to 100 biggest enterprises in the world. So Nigeria run the maths and find out that based on this narrow scoping, the rule will not bring enough back home in terms of revenue. So that was one of the reasons. The second reason was that the rule had as a precondition that countries that adopt the rule must also adopt mandatory binding arbitration with respect to revenue. And Nigeria said no, under our constitution, that they don't see the possibility of applying arbitration to revenue. Then the third option, again, is option around digital service taxes and related measure, or what they then called unilateral measures. Nigeria was scared that our significant economic presence rule and other similar efforts we are making to tax digital enterprises operating within our jurisdiction may be stopped with respect to all companies, not just the 100 in scope MNEs. So these were the reasons adduced. Now, we have the Pillar 2 part. The Pillar 2 part is the global minimum tax, the GLOBE rules, and the STTR. The GLOBE rules is designed in a manner that if you as a country, let's take Nigeria for instance, if you have its profit-based incentives, tax holidays and the rest of them, and by virtue of having those incentives, you are unable to tax an MNE operating in your jurisdiction to the tune of 15% ETR. Recall, 15% ETR is different from 15% headline rate. Our headline rate is about 30%, but our effective tax rate is between 8 to 10%. So if you do not tax the profit of any MNE in your country up to 15% ETR, the remaining balance will not be retained as benefit by the MNE. Instead, it will be taxed by the jurisdiction of the ultimate parent entity of the MNE. So by the rule design, it's very clear that any country whose effective tax rate is not up to 15% must respond. So one way or the other, Nigeria is expected to respond by their fiscal policies. Now, there are rules that they can adopt within the inclusive framework suite of rules, which will include the qualified domestic top-up tax rule, which some people have criticized, among other measures. But there's also the reform they could carry out in their domestic tax system, which may include incentive reforms. And this is important for businesses to know because it will come. Incentive reforms, alternative minimum taxes, and other effort to push the ETR to 15%. So you find out now that the position of Nigeria cannot be the same with respect to Pillar 1 and Pillar 2 necessarily. Now, taking it down to July 2023, Nigeria have now endorsed an outcome statement of the inclusive framework, OECD inclusive framework, supporting the rules. What have changed? What have changed is that Nigerian significant economic presence rules are no longer considered digital service, are not considered digital service taxes. And to that extent, it's going to apply side by side with whatever happens under Pillar 1, with the caveat that it cannot apply to those 100 in-scope MNEs. All right? And then secondly, Nigeria have also, with other developing countries, have been able to push and get a concession that mandatory binding arbitration will be elective for some African countries with certain threshold in terms of GDP. So all in all, having endorsed the outcome statement also does not translate to Nigeria implementing the rules in the first place, because outcome statement is a political arrangement, or you can call it administrative. It's not a binding treaty. The binding treaty will be open for signatures for countries between now and the end of the year, and it is called the Multilateral Convention on Pillar 1. If Nigeria signs onto that, we cannot beat our chest to say the position of Nigeria is that they are implemented. But as at this moment, I could tell you from my experience and my perception that Nigeria is still testing the waters, looking at the rules as they develop to see what will be the final policy position they will take with respect to both Pillar 1 and Pillar 2. Thank you.
Thank you so much, Mr. Isaac. We've heard from Mr. Isaac the current position of the Nigerian government in relation to Pillar 1 and Pillar 2 as proposed by OECD. And again, we've heard him, the views he has expressed is that of his view, and though he wants work for Nigerian government, and that view does not represent the view of the Nigerian government. Thank you, Mr. Eze. Now, moving ahead, Mr. Arubike, let me come to you. Could you enlighten us on the obligations of NRCs, the non-resident companies, regarding their withholding tax obligations, and how is this different from the withholding tax of that of Nigerian companies?
Thank you, Mr. Adewale. Just in brief, under the withholding tax in Nigeria was introduced under the Companies Income Tax Act, and it is limited to passive investment income, including interest, dividend, rents, royalties, and directors' emolument. The subsequent withholding tax regulation extended its scope to other payments such as commission, construction contract, and all contract and agency arrangements. And the Finance Act also added or extended the withholding tax clearly to technical management, consultancy, and professional services. Now, the main difference between a Nigerian companies and non-resident companies regarding withholding tax is that the non-resident company has no withholding tax compliance obligation. It is the responsibility of the local counterparty which must withhold and remit taxes on the qualifying payments meant for the non-resident company on the applicable to the income tax subject to withholding tax. The second point of difference is on the effect of withholding tax on Nigerian companies and non-resident companies. The Nigerian companies, for Nigerian companies, withholding tax serves just as an advanced tax payment, and they are entitled to a tax credit for the withholding tax paid when accounting for their annual income tax during the assessment year. However, for the non-resident company, withholding tax represents the final and ultimate tax liability. Another difference is on the filing of tax returns on withholding tax. Unlike Nigerian companies, non-resident companies whose income is only subject to withholding tax deductions are not required to file tax returns in Nigeria unless they have earned other incomes other than from withholding tax. There's also a controversy regarding withholding tax. The extent to which a non-resident company could be subject to withholding tax, especially on the payment for the services listed under withholding tax regulation, particularly the one called all contracts and agency arrangement other than contract in the usual course of business. This is not an issue for Nigerian companies, because withholding tax is merely an advance payment of tax and is creditable even if there is no taxable income. However, for non-resident company, how do you now subject a non-resident company on all the contract that it has entered other than what the statute, the regulation called contract other than the usual course of business? In essence, this is more like a disguised turnover tax. So in essence, the issue here is whether the minister has the right to impose turnover taxes through a regulation. The minister cannot, because turnover taxes is imposed under Section 30 of Companies Income Tax, as I have also mentioned and the have also highlighted. And there are conditions for imposition of turnover taxes. However, the issue on whether the minister can actually tax all contracts of non-resident company through withholding tax process is still a subject of controversy, and these have not been judicially resolved. But that said, the withholding tax regulation cannot apply to companies, non-resident companies registered in a country that has double taxation treaty with Nigeria, unless there is a specific such payment is recognized under the treaty arrangement. As we have already pointed out, once there is a conflict between the tax statutes or regulation and the treaty provision will supersede. So to the extent that we don't have such provision in the treaty, you cannot tax a non-resident company that is from registered in a country that has double taxation treaty with Nigeria under the broad item or contract and agency arrangements other than contract made in the usual course of business. Again, while some withholding tax rate, the same withholding tax rate applied to both Nigerian companies and non-resident companies. They differ in terms of who bears the withholding tax obligation and also the resulting effect of withholding tax. Thank you, Mr. Adewale.
Thank you, Mr. Arubike. Now, let me just take you on what you have said regarding the changes between a non-resident company and a Nigerian company with respect to their withholding tax obligations. Now, considering the changes in the tax regime for the NRCs, can you share your insight with us on the implications of FRS? I know you talked about the powers of the minister to tax the contracts of the NRCs, which is still subject to controversy anyway. But what are your views in relation to the FRS power to appoint NRCs as VAT collection agents vis-a-vis the decision of the tax tribunal in relation to both operators, both and FRS? What can you say about that?
Well, the case of both operator and the FRS is a peculiar one. It's peculiar in the sense that in the transaction, both is neither the consumer nor the supplier of product or services in question. It is both merely play the role of a facilitator or aggregator in the transaction chain. And also as an agent and recipient of commission, both is liable to pay its own withholding tax. However, under Section 10, Subsection 3, FIS had the power to appoint non-resident companies and any other company as a VAT collection agent. And based on this section, FIS now appointed both and also other ANOVA as both as a VAT collection agent, and both sued at the tax tribunal and lost. For me, I think the appointment of both as a VAT collection agent is in order, and the decision of the tax tribunal affirming same is also correct. Now, VAT potentially is one of the most significant taxes in Nigeria, and challenges of the FIS have been on how to ensure maximum collection. And FIS have employed several methods to boost VAT collection. It has enlisted government ministries and agencies, has enacted a reverse charge mechanism applicable to all consumers. And not long ago, the FIS also appointed major telecommunication companies and banks as collection agents, extending the practice that have been in place for oil and gas sector. Now, there is no legally defensible argument against that appointment, and I've checked and looked at it to see how it could have been otherwise. No, I don't see the decision as a wrong one. The Finance Act, in fact, amending the VAT Act, empowers FIS to appoint such other person to withhold and remit VAT. So I don't see how both can escape this, because such other person could be anybody. And remember, in this in the transaction chain, VAT is paying both is playing a very critical role. And all it takes for vote to collect VAT is just to change its pricing mechanism by adding 5% to the transport charges, to adding 7.5% of the transport charges to the distance, and we'll be able to collect it at the time we reconcile each account with the drivers and the food vendors. However, all I can say that the case is highly significant in a crucial respect. It demonstrates that while the digitalized economy poses challenges for the revenue authority, it also presents opportunity that the revenue authorities can leverage to enhance tax collection efforts. For instance, in the case at hand, it's obvious that some of the service providers, the drivers, food vendors, may typically not be able to account for VAT on the consideration they receive. But this will make VAT collection a very challenging task and for the revenue authority. However, by using a tech company like Bolt, Uber in between, and by their nature of their operation, they can actually interface between the suppliers and the consumer, both in especially in revenue collection. The process of VAT collection can be made much more manageable and efficient. So I think the decision is in order, and there's no way to fault the decision. It will boost VAT revenue collection, and VAT can actually, and both and OBA can actually implement the appointment without much difficulty.
Yeah, thank you, Mr. Arubike. Why I may have a different opinion from you, certainly, Mr. If I have to ask Mr. Isaac, I know he will share your view, being an FRS former employee. And though, yeah, as you said, both is neither a consumer nor the supplier of the service. Then why appointing a non-party, so to say, to be a VAT collection agent? But again, the debate goes on. I know we have time constraints. We have less than 10 minutes to the end of the webinar. Let me just move ahead and ask Mr. Easy. No, not in relation to VAT and NRC as VAT collection agents. But let me ask you, what do you think are the challenges faced in implementing the new legal regime on the taxation of NRCs? And how do you think these challenges can be addressed, or is being addressed as being a former employee of FRS? Maybe you can share your insight with us on this. Thank you.
Thank you very much, Mr. Adewale. As we have highlighted in all our presentation, my experience trying to working in arm of government that sought to tax non-resident, at least from a fiscal policy perspective and from legal perspective, is one. The rules that governs taxation of non-resident is complex. When the rules are complex, there is high cost of compliance, and there is also high cost of administration. So the interaction of the rules of one, talking of digital economy now, when the entity is resident and then where it is deriving income, the interaction of those rules are very complex. And to solve this problem, the only solution is that countries have tax treaties, because tax treaties define what happened at any given point in time. And that simplifies the issue both for the taxpayer and for the tax administrator. Then the second major issue is what I call enforcement. So a company is outside your jurisdiction, you have derived income from your jurisdiction, and from your own rule, the income is liable to tax in your country, but the company is not in your country. How would you enforce the tax rule? You know, it becomes a difficult question, and much more so when the company is not a company that is sensitive about its reputation, or you do not have what they call mutual administrative assistance in tax matters agreement with the jurisdiction of the MNA. So the solution to this challenge again is that countries should seek to have mutual administrative assistance in collection of taxes with other countries. This is pertinent especially for Africa in view of the African Continental Free Trade Area Agreement. So you have to continue to have such agreement to facilitate this happening. Then there's also the issue of political will. The MNAs that come from outside our shores are powerful and they have high lobbying powers. If your politicians are not strong, it will be difficult for you to enforce the rules on a lot of them, especially again, the ones without reputations. So these are key challenges. And there's also the challenge that a tax authority in their approach should continue to produce information circulars, guidance notes, clarifications, private rulings, and all that is necessary to make it easier for multinationals to comply. So in essence, the problem with taxing multinationals can be summarized in some of these elements I have mentioned. There are more, but for want of time, I will just rest it there. Thank you.
Thank you, Mr. Ese. As I said, even though we have 2 hours for this session, I'm not sure is sufficient to address all of the issues arising in relation to corporate tax of NRCs. We just have less than 6 minutes to the end of the webinar. I know there are questions that members of the audience have asked. I'll just try to ask a few of them as time may permit us. Let me ask, and any one of you can answer the question that has been posed by the member of the audience. We have a question relating to digital tax regime, and the question is: will the digital tax regime introduced by the Finance Act apply to NRCs that are resident in a country that has a double tax treaty with Nigeria? I know this question has been answered in the course of Mr. Arubik's responses to one of the questions, but I think I will give you opportunity to address it once again. Please, over to you. Or Mr. Isaac, any one of you can answer this question, please.
Yeah, I think the question has been addressed in course of my intervention earlier on.
Yeah.
But suffice it to say that the answer is no.
No.
If you have double taxation agreement with a jurisdiction where the MNA is doing business from, the double taxation agreement and the provision will apply, not the SCP. I think that's a simple answer to that question. Thank you.
Yeah,
Okay, thank you.
my answer is also no. As I've said earlier on, we don't have SCP provisions in the double tax treaty that Nigeria entered with their treaty partners. Unless those treaties, unless there's amendment to those treaties, we still have to apply the old regime.
Okay, I think I have another question here, which in relation to another, though it's not covered by the topic because we said it's limited to corporate tax and company income tax and VAT. But let me just ask for the purpose of completeness so that at least we can provide guidance if you have that. Is a non-resident company liable to pay police trust fund levy?
I think this question depends on whether the non-resident company is operating in Nigeria. If you look at the police trust fund, act, so that this catches companies operating business in Nigeria. So if the non-resident company is operating a business in Nigeria, it will be liable to pay the tax. Now, when you now compare this to the provision under the Tertiary Education Trust Fund Establishment Act, which only applies to companies registered in Nigeria, you can see clearly that there's intention to tax non-resident company to the extent that that non-resident company is operating a business in Nigeria, directly or indirectly. So that's just my simple answer to the question.
Okay, I have another question here. I think that will go to Mr. Eze. I think it's in relation to the position. I think we've answered the question already about. I'll just ask you again in relation to the two pillars solutions. And the question is, how does Nigerian approach to taxing non-resident companies in the digital economy compared to international standard practice?
Thank you, Mr. Adewale. As a matter of fact, that's the whole essence of the intervention I had earlier on. I could say again, in addition, that Nigerian approach is very cautious. Nigeria is considered one of the models for developing countries when it comes to these issues. They are trying to have a nuanced and balanced approach. So you see, they have not gone the way of DST because that is a bit considered by some people not to be very friendly. They have built something around the corporate income tax, and that is where the direction Nigeria is going, which is also considered very acceptable to many.
Thank you. I think we have less than 1 minute to go. I don't know whether it will be sufficient to answer this question. Is in relation to the power sector and the new tax regime. And the question is, how does the new tax regime affect the power sector and tariff payable by consumers? Mr. Rubike, we have time to address this question before.
This question is either here nor there. It's very, very vague. But all I know is that the VAT modification order of 2021 exempt some of the players in the power sector from VAT, but there's no exemption to power supply from the disco to the final consumer. But in the transaction chain, that's from gas company to generation company to bulk trading company to transmission company. There's a VAT exemption in that chain, but the supply of power from the power distribution company to the final consumer is not VAT exempt. So to that extent, the VAT will only apply at the when the final product is supplied to the consumer.
Thank you. As I said, we are on the time. It's 2 o'clock. 1 hour spent. It has been very, very robust and very, very fruitful discussions about the recent developments in relation to corporate tax that relates to the NRCs. Thank you, Mr. Arubike, for your views expressed, and Mr. Eze for doing so. I thank you and the participants for coming on board. I know there are other questions. You can reach out to Mr. Ize or Mr. Arubike via the question box. We'll get them and they can address them to you offline. Please, thank you. I will now hand over back to Dan. Dan, over to you, please. Thank you.
Thank you very much, Mr. Adewale.
Thank you very much, Fidelis. And I would like to say on behalf of Mondat, thank you to all of our panelists today, to Emmanuel and Stephen for your fascinating insights, and of course to Fidelis for bringing everything together and moderating today. And of course, thank you to our audience for being with us today. We really appreciate it. Please do send any questions that you have into our panel, and they will make sure to have those answered for you. But for now, I wish you a lovely rest of your day. Goodbye.
Thank you, everyone.
Thank
Bye.
you.